how you can be able to prepare what we call a cash flow statement. And therefore, you can be able to write cash flow statement, IS number 7. So cash flow statement, IS number 7. Can be able to write cash flow statement. It is under International Accounting Standard number 7. So the cash flow statement. So you are looking at the cash flow statement. Cash flow statement is under International Accounting Standard number 7. So this is still under published financial statements. Is still under published financial statements. It is still under published financial statements. So we can, in this case, first of all, be able to try and actually define what is a cash flow statement. You can be able to write definition. You can write definition of as what in this case is a cash flow statement. We can write definition. So you write this about a cash flow statement. It is a statement showing, the sources of cash. It is a statement showing the sources of cash. From revenue and capital transactions. It is a statement showing the sources of cash from revenue and capital transactions. So a statement showing, it is a statement showing the sources of cash from the sources of cash from revenue and capital, from revenue and capital transactions, from in this case revenue and capital transactions. You can give examples of these transactions. You can give examples, e.g., and say, e.g., what are these transactions you're having to talk about? So, e.g., sale of goods, e.g., sale of goods, e.g., sale of goods, comma, sale of assets, e.g., sale of goods, comma, sale of assets, comma, issue of shares, etc. So, e.g., sale of goods, sale of assets, e.g., sale of goods, comma, sale of assets, comma, issue of shares, etc. Issue of shares, etc. Issue of shares, etc. Issue of shares, etc. Full stop. Then you write the second statement. After that, you write another statement. After that, definition. And you write another statement after that. So you write, it will also show how the cash is utilized. It will also show how the cash is utilized. It will also show how the cash is utilized. The cash is utilized in meeting the expenditure. It will also show how the cash is utilized in meeting the expenditure. It will also show how the cash is utilized in meeting the expenditure for the company. 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 So ideally, under the cash flow statement, you are looking at how is cash having to come in and how is cash having to go out. How is cash having to come in and how is cash having to go out. So in this case, looking at what was the opening balance in terms of cash. Maybe it could be at hand or at bank. And how eventually did we arrive at the cash at hand or in the bank at the end of the financial year. So we're just looking at the inflows and outflows in terms of real cash. In this case, within what the business enterprise, or in this case, within what the company. So we can look at part of the key terms that in this case we are looking at. We are talking about a cash flow statement. You can write definition of key terms, definition of the key terms, definition of the key terms, definition of the key terms. in terms of, in this case, what a cash flow statement, definition of the key terms. So the first term in this case I want us to define is, in this case, what we refer to as cash. What is cash? In this case, I want us to define what, in this case, exactly what cash. So define cash. So this represents cash in hand. This represents cash in hand. This represents cash in hand and cash at bank. This represents cash in hand and cash at bank. This represents cash in hand or cash at bank. Cash in hand is what you have at hand in the business. Maybe in this case, it is actually in your safe. So it is actually in your safe. And in this case, the cash you have also in this case at the bank is what now in this case is in the bank. You've actually been able to put it under safekeeping in the bank. So we combine the two, we end up having to have what, the cash. And of course, that is basically what in this case you are looking at. What is the opening figure in terms of the cash either at hand or plus that one in the bank? Or in this case, we are having to look at the end of it all, what will in this case remain as the cash either at hand or in this case and or what is actually in the bank. So that's what in this case you're having to mean by cash here. So number two term that is actually very key, you can be able to write cash equivalence. Cash equivalence. We normally talk about cash equivalence. Cash equivalence. So sometimes in this case within the business we could be having assets that in this case sometimes they could be able to represent what cash. They're not in this case real cash, but you can easily convert them into what, into cash. For example, if you put your money under a fixed deposit account, you can easily convert it into cash at bank because you tell the bank you want to draw out of, in this case, what, the fixed deposit account. So those are like in this case what, cash equivalents. They're in this case not real cash, but they're in this case instruments or maybe assets within the company that can be able to represent cash. So you can write this. These are short-term, highly liquid investments. These are short-term, highly liquid what, investments. So these are short-term. These are short-term, highly liquid investments. These are short-term, highly liquid investments. Highly liquid investments. These are short-term, highly liquid investments. Highly liquid investments that are readily convertible to cash. 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 You can easily convert them into cash. You can give examples. You can give examples of these readily convertible instruments or maybe assets or investments that you can easily convert them into cash. You can give examples, e.g., treasury bills, treasury bills, treasury bills, treasury bills, e.g., treasury bills, bonds, etc., e.g., treasury bills or bonds, etc. So they are known as what, cash equivalents. It's just your cash, but now in this case it is held by another entity. So you can easily sell it to be able to, in this case, have what, real cash, to be able to have real cash. Then we have number three, another term that I want you in this case to write is what we call non-cash items. When we'll be preparing the statement of cash flow, we'll talk about non-cash items. So you can talk about another term. Another term you can be able to write, number three, is what we call non-cash items. Non-cash items. So non-cash items, what are in this case these non-cash items? So what do you mean by non-cash items? You write this. Non-cash items. These are items of income or expenses. These are items of income or expenses. These are items of income or expenses which do not involve cash inflows. These are items of income or expenses. These are items of income or expenses. These are items of incomes or expenses which do not involve cash inflows or outflows. Which do not involve cash inflows or outflows, which do not involve cash inflows or outflows. You can give examples of these incomes or expenses. You can give examples, e.g., depreciation, and give examples, e.g., depreciation, allowance for bad debts, allowance for bad debts, allowance for bad debts, allowance for bad debts, amortization, allowance for bad debts. So they are like, in this case, expenses, but they don't actually really involve real outflow of cash. So of course, when we be preparing the cash flow statement, there's a way we treat them. So you'll be able to see. There's a way in this case you are supposed to, in this case, add them back, because we would have already been able to deduct them, like as if money went out in the income statement. But ideally, no money went out. When you talk about depreciation of an asset, it doesn't involve real cash of money going out. But in this case, you account for it under what the income statement. Is that as if in this case is like, in this case, if it's electricity you've paid. So you paid Kenya Power, money has gone out. But now when you recognize another expense in the income statement, like depreciation, there's no money that you pay. But in this case, it's just what a loss of value of an asset. That in this case, you recognize as an expense. It is a non-cash item. It doesn't involve real outflow of cash or you having to pay out money. So in this case, there's a way we treat them in the cash flow statement. We add them back. We add them back because no money went out, but it was of course deducted in the cash flows of what the reporting entity. So no money went out. We end up having to add them back. They don't actually involve real outflow of cash. When you do talk about allowance for bad debts, it's just an allowance you've made, but it doesn't mean that in this case you paid this money out. So in this case, you deducted on what? On your trade receivables or debtors, or you recognize it as what? As an expense. But in this case, ideally, no money you ended up having to pay out. You just made an allowance. You just made what? An allowance that you never paid out. Amortization, for example, in this case, it is an intangible asset. If it loses value, in this case, we say it has actually been amortized. It doesn't involve real outflow of cash, but now in this case, it means you've actually been able to recognize it as an expense. You have to, in this case, add it back as a non-cash item. So you can talk about amortization. ETC, so in this case, others talk about amortization, ETC, amortization, ETC. So we can, in this case, have number 4, we can write number 4, another term, cash flows, another term, cash flows. So we've talked about cash flows. We talk about these cash flows, what do you mean? Cash flows, what are cash flows? So what are cash flows? I write the term cash flows. What are cash flows? You write this. These are inflows and outflows of cash and cash equivalents. These are inflows and outflows of cash and cash equivalents. These are inflows and outflows of cash and cash equivalents. You've already been able to define what is cash. The money you have at hand or in the bank. A cash equivalent, what you have in this case as instruments or investments that can be able to represent cash. You can just easily convert them into cash. So when we talk about a cash flow, we are having to say these are inflows and outflows of cash and cash equivalents. So they are flowing. They're either flowing out or in. These are inflows or outflows of cash and cash equivalents. Then we have another term that in this case, you have to also in this case be able to know. We have in this case the operating activities under the cash flow. So you can be able to write operating activities. Operating activities. So when you'll be in this case looking at the format of the cash flow statement, one of the categorization of in this case the cash flows will actually be in this case under what we call the operating activities. One of the categorizations or the different categories in the cash flow, there's in this case what we call the operating activities. What are in this case these operating activities? What are operating activities? You write these about operating activities. These are revenue generating activities of an enterprise. 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 Those activities undertaken to get revenue. So in this case, this basically we're talking about what items in the income statement. So these are revenue generating activities of an enterprise. You can give an example, e.g., sale of goods, sale of goods, e.g., sale of goods, e.g., selling of what of goods. These are revenue generating activities of an enterprise, e.g., sale of goods, e.g., sale of goods. The number 6, another term, is still in this case a category under the cash flow statement, investing activities. Investing activities. Investing activities. So you write this about investing activities. Investing activities. These are activities that involve sale of fixed assets. These are activities that involve sale of fixed assets. These are activities that involve sale of fixed assets. These are activities that involve sale of fixed assets, comma, acquisition of fixed assets, acquisition of fixed assets, sale of fixed assets, comma, acquisition of fixed assets, acquisition of fixed assets, comma, disposal of investments, disposal of investments, disposal of investments, disposal of investments, etc. Disposal of investments, etc. Disposal of investments, etc. Disposal of investments, etc. So this is another category of their cash flows in the cash flow statement. So here what we'll be looking at under that category in the cash flow statement, we'll be looking at, was there any form of acquisition of an asset? That is an outflow. Was there, in this case, any form of disposal of an asset? They sold an asset. So that's in this case an inflow. So any of those kind of activities having to occur, they'll be categorized under what we call what investing activities. Then in this case, you have number 7. Number 7, you can be able to write, still in this case, another category in the cash flow statement. We refer to it as financing activities. Financing. We refer to it as financing activities. You write this about financing activities. Right? These are about financing activities. These are activities that result in changes. These are activities that result in changes in the size. These are activities that result in changes in the size. These are activities that result in changes in the size, and composition. Size and composition. They involve result in changes in the size and composition. Size and composition of the capital or equity. Composition of the capital or equity of the company. The capital or the equity of the company. The capital or equity of the company. The capital or equity of the company. The capital or equity of the company. E.g., the capital or equity of the company, e.g., issue of shares, e.g., issue of shares, e.g., issue of shares, e.g., issue of shares, comma, redemption of shares, redemption of shares, redemption of shares, redemption of shares, comma, payment of dividends, 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 etc. Payment of dividends, etc. Payment of dividends, etc. Payment of dividends, etc. Full stop. So investing activities, I'm repeating. We are saying investing activities. These are activities that involve the sale of fixed assets, comma, acquisition of fixed assets, comma, disposal of investments, etc. Investing activities, these are activities that involve sale of fixed assets, comma, acquisition of fixed assets, comma, disposal of investments, etc. 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 So those are in this case part of the key terms that in this case you're having to look at. So in this case, I want us in this case we look at the format as to why in this case the cash flow statement will likely end up having to look like. And of course, there are two methods as to why you can be able to prepare the cash flow statement. We have what we call the direct method, and we have in this case what we call the indirect method. The indirect method is the commonly used and commonly tested. It is the commonly used and commonly tested. So the indirect method is the commonly used and commonly tested in the exam. So the indirect method is the commonly used and tested in the exam and tested in the exam. So you can be able to write, methods of preparing the cash flow statement. So methods of preparing the cash flow statement, methods of preparing the cash flow statements. Then you write, there are two major methods of preparing the cash flow statement. There are two major methods. Methods of preparing the cash flow statement. Preparing the cash flow. There are two major methods of preparing the cash flow statement. The cash flow statements of preparing the cash flow statement, i.e., number one, the indirect method. Number two, the direct method. The direct method. So this is the mostly commonly used, this one, and the mostly commonly tested. So in this case, you can be able to write the indirect method as a title. The indirect method as a title. The indirect method as a title. You can write the indirect method as a title. The indirect method as a title. The indirect method as a title. So you can write under this method, you write something small before you look at the format. You can write under this method, comma, the cash flows from operating activities under this method, the cash flows from operating activities under this method, comma, the cash flows from operating activities under this method, comma, the cash flows from operating activities are determined by adjusting the profit before tax, by adjusting the profit before tax, with the following. Under this method, comma, the cash flows from operating activities. Under this method, comma, the cash flows from operating activities are determined by adjusting the profit before tax with the following. The profit before tax with the following. Semicolon, with the following semicolon. All non-cash items, A, you put A and say, all non-cash items. So non-cash items we've been able to define like depreciation. So we'll start in this case with the profit before tax. Then in this case, on this profit before tax, you adjust all non-cash items e.g. depreciation, e.g. depreciation, e.g. depreciation, amortization, amortization, allowance for bad debts, allowance for bad debts, allowance for bad debts, etc. Allowance for bad debts, etc. Allowance for bad debts, etc. The number 2, changes in the current assets, changes in the current assets, and liabilities, changes in the current assets and liabilities during the year. During the year, changes in the assets and liabilities, changes in the current assets. You can say current assets and current liabilities, changes in the current assets and current. Changes in the current assets and current liabilities during the year. So in bracket, you can be able to say working capital items. Working capital items. These are working capital items. The current assets and current liabilities are working capital items. This is what in this case we rely upon to run like the daily operations. It's like in this case what you rely upon to run the daily operations. In brackets, you put working capital items, working capital items, working capital items. And then in this case, I want us to look at the format. I want you to draw up the format before in this case we start looking at an illustration. In this case, you can be able to prepare a cash flow statement. I want us to draw up in this case what the format. Very fast, we draw up the format. Hope you've been able to write that. I want us to look at the format. So format of the cash flow statement. Format of the cash flow statement. I want us to draw up the format of the cash flow statement. I want us to draw up the format of the cash flow statement. So what am I repeating? So what am I repeating? Is it the first one or the second one? Is it the first one or the second one? You need to type there very fast. I will repeat. You need to type there very fast. I will repeat. So I repeat under this method. So under this method, cash flows from operating activities. Under this method, cash flows from operating activities are determined by adjusting the profit before tax with the following. Under this method, cash flows from operating activities are determined by adjusting the profit before tax with the following, semicolon. Number A, we said all non-cash items. All non-cash items. All non-cash items. We've given examples, e.g. depreciation, amortization. All non-cash items, e.g. depreciation, amortization, allowance for bad debts, allowance for bad debts. Then part B, changes in the current assets and current liabilities during the year. Changes in the current assets and current liabilities during the year. In brackets, working capital items. In brackets, working capital items. Working capital items. So how does we look at the format? So you draw up this format because what in this case, that's what you're going to use to prepare the cash flow statement. So in this case, format for the cash flow statement, indirect method, format, cash flow statement, the indirect method. So we can say XYZ Limited cash flow statement, cash flow statement. We can say XYZ Limited cash flow statement, cash flow statement, cash flow statement for the year ended, for the year ended. For the year ended, it can be 31st of December of a particular year. 31st of December of a particular year. So in this case, you'll start with the cash flows from operating activities. You'll start with the cash flows. Cash flows from operating activities. So you can start with the cash flows from operating activities, which you have to put aside. So there, suppose your shillings will be there, representing certain shillings. So in this case, you start with the profit before tax. Profit before tax, which you'll get in the income statement extract. Profit before tax. You start with the profit before tax, you place the figure there. So on the profit before tax, you adjust with what we call the non-cash items. Adjustments with what the non-cash items. So adjustments. Adjustments of non-cash items. Non-cash items. So you adjust in this case the non-cash items. Under the non-cash items, you'll put, for example, depreciation. In this case, you can put depreciation. And put amortization. You can put loss on disposal. Loss on disposals. You can put gain on disposals. You can put, for depreciation, in this case, you'll add, this one you'll add. It doesn't represent a real outflow of cash, so you'll add. Amortization will also add. Loss on disposal, you'll in this case also add. In this case, add. Loss on disposal, you'll likely end up having to add. Gain on disposal, you deduct. It doesn't represent a real inflow of cash. It's just a gain you've calculated there. It doesn't represent a real inflow of cash. And therefore, you'll likely end up having to deduct. You'll deduct. You can, in this case, which is also very common, here you'll end up having to add back what we call the finance cost. Finance cost is interest. So you'll add it back. You'll likely add it back here. You'll add it back here. You'll add it back there. Actually end up having to add it back there. Then after that, you'll get a total. You'll get in this case what a total. So with this total, you likely consider the changes in the working capital items, or changes in what in the current assets. So changes in working capital items. You'll have in this case the changes. On this figure you've gotten here, you'll have the changes in working capital items. Working capital items, changes in working capital items. The working capital items that in this case you'll commonly find is, for example, inventory. You'll find accounts receivables and accounts payables. Inventory, accounts receivables, and accounts payables. So in this case, we have an increase in the those current assets. So increase in current assets. You likely end up having to deduct. You likely in this case deduct. Then a decrease in current assets. Current assets, you likely end up having to add. You likely add. So they operate like that. So in this case, those current assets items are having to increase. You will deduct. In this case, end up having to deduct. But in this case, they are ending up having to decrease. In this case, they are having to decrease. You likely in this case end up having to add. So decrease in the current assets, you end up having to add. Then increase in the current liabilities. If the current liabilities are having to increase, now is the opposite. Increase in current liabilities. You'll add. Then a decrease in current liabilities. You deduct. You deduct. decrease in the current liabilities, you likely end up having to deduct. The decrease in the current liabilities, you likely end up having to do a deduct. So probably in this case, it means you have incurred an outflow. You likely have incurred an outflow. So that's what will happen. In this case, for current assets here, we have something like, in this case, what inventory. So like in this case, maybe they can tell you on 1st of January, 2025, inventory was at 10,000. Then on 31st, they give you 2 years, 31st of December, inventory was maybe 15,000. So there was an increase. There was an increase. So in this case, you open with inventory of 10,000, and then at the end of the day, you have like 15,000. Probably in this case, you must have incurred some cash to go to this level, to buy more goods to sell. So in this case, you'll deduct because it has increased. You'll deduct because if you open with an inventory in your shop of 10,000, then at the end of the day, you have 15. You must have incurred more cash to buy 5,000 extra to come to 15. So you will deduct. You will deduct like that. Then if in this case it happens you open with 10, then by the end of the day you have 5. It means in this case you must have sold some. So and then in this case, it means you've gotten money. So you must have released some that has gone out. So therefore in this case, you must have received some money. And therefore in this case, you add is an inflow. Assuming it is accounts receivables, because it's also very common. If you open with an accounts receivable means it is what? Debtors. You are claiming from debtors 10,000. You are claiming from debtors 10,000. You are starting your new year. Your new year, mwaka mpya, you are starting with 10,000. When you are closing the year, the debtors have reduced to 5,000. That means you must have received some money. They must have paid you already. Those debtors of yours must have already paid you. So you must have received some money. That's what you're having to say. That decrease you add on the current assets, you do what? You add. So the same case happens with the liabilities. Let's assume it is payables. Payables are your creditors. Payables are your creditors. So you open that with a figure of, in this case, how much? 10,000. Those you are supposed to pay, wale wanakudai. When you kuna madeni now, umekopa kwao ni 10,000. Kuna madeni, so payables ni 10. But when you are closing the year, they have reduced to 5. It means you must have paid them. You must have paid them, and therefore money is going out. So therefore, in this case, you're having to say a decrease in the current liabilities is an outflow. Because if you open with 10, then by the end of the year, you're closing with 5. Means you must have paid them. You must have paid them. And that's why in this case, we do that. So that's basically what is happening there. So with this, then now you can be able to close. You likely end up having to close. You close those figures. You close those figures there. Then once you close there, you'll in this case consider the tax paid and the finance cost. In this case, less tax paid and you less what? The finance cost. So less than the tax paid. And in this case, what? The finance cost. Less the finance cost. So this you likely be able to get the net cash flows, the net cash flows from operating activities. Net cash flows from operating activities. So, and that basically will be your first part of the cash flow statement from operating activities. The cash flows from operating activities, you'll close it there. You will close it there. You will close it there. You cannot see down there. We have not included dividend paid. Why? Dividend paid, it will likely go to the financing activities. It will go to the financing activities. Sawa. Dividend paid will go to financing activities. So there's an X here. There's nothing new here. Just put an X down here. You put an equal sign, then you put an XX. Then you continue with your table, changes in working capital items. So once you close it, you put an XX. You will now continue with your table. Remember, don't put your table beside like the way I'm doing. You just continue with it like that. There are some people who have already drawn a line like this. So they have started writing this side. Don't do that in your book. You just continue with the table. It is still flowing. In fact, we haven't come to the end. We are still continuing. So don't draw another line, then you start putting this side. Don't do that. I've done that because you cannot be able to sit down here. So after finance cost, you put an equal sign, you put an X, then you continue. Changes in working capital down there, you continue as you go like that. You write these ones up to here. And the table is still continuing. So it hasn't come to an end. So I'm going to continue here. So you're going to the next one, which in this case is actually what? The investing activities. So you go to the next part of the cash flow statement. So in this case, you write cash flows from investing activities, cash flows from investing activities. You write cash flows, another heading of the cash flows from investing activities. So cash flows from investing activities. So here, you'll consider, for example, acquisitions and sale of assets. So majorly that is what is normally happening here. So you can have in this case like acquisition of property, plant, and equipment. So acquisition of property, plant, and equipment. This one, money was going out, so you deduct. Money was having to go out, you do what? You deduct. You deduct in this case there, you deduct in this case there. So proceeds from a sale of PPE. So proceeds from sale of PPE. Proceeds from sale of PPE. This is an inflow. Money is coming in. Maybe there can be proceeds from sale of investments, proceeds from sale of investments. And if you had shares, then you sold. Proceeds from sale of investments, that is an inflow. That is an inflow. Maybe in this case, it can be acquisition of investments. That is an outflow. Acquisition of investments, that is an outflow. You deduct. So majorly that is what normally happens there. So acquisition and sale of assets. So of course, that is the end of the second part of the cash flow statement. So that is part B. That is the end of the second part of the cash flow statement. That is part B. That is part B. Then we go to cash flows from financing activities. So cash flows from financing activities, cash flows. You continue with your table, cash flows from financing activities. That is the third part and the final part of the cash flow statement. Cash flows from financing activities, and of course, you can be able to underline. These are basically involving financing activities, cash flows. So you write issue of shares or debentures. So when you issue shares, issue of shares or debentures. Issue of shares or debentures. That is, in this case, an inflow. When you sell shares, you get money. So you look, is a positive, you add. Is a positive, you add like that. Issue of shares. Issue of shares or debentures. So you add like that. Issue of shares or debentures, you add like that. Loan acquisition. Loan acquisitions. Maybe you got a loan. A loan, when you get it, is normally an inflow. So when you are given a loan by the bank, money is coming in, is an inflow. Loan acquisition. Payment of dividends. Payment of dividends. Payment of dividends. So you put it there. Payment of dividends, you put it there. Payment of dividends, you put it there. Payment of dividends, you put it there. So you put here payment of dividends. Then we continue. So we continue here. Continue here. So we continue with the cash flow statement. Payment of dividends, you put it here. There can also be a redemption of shares. There can also be redemption of shares. This one you deduct because you are paying. So you deduct like that because you are paying the dividends. So you can, in this case, have redemption of shares. When you are redeeming shares, you pay. So redemption of shares. And now redemption of shares. So you can be able to put it there here. You deduct, so you can have redemption of shares. So that's when you deduct like that. When you're redeeming shares, you are buying back your shares. So that in this case, you deduct. we deduct. The redemption of shares, we likely in this case deduct like that. So then in this case, you'll have the net. This was supposed to be this, they were supposed to be here net. You write here net cash flows from investing activities. You write here net cash flows from investing activities. This is what this figure represents. So this is supposed to be net cash flows from investing activities. Then here, you'll have the net cash flows from financing activities. The net cash flows from financing activities. Net cash flows from financing activities. So that will be our part C of the cash flow statement. That will be our part C of the cash flow statement. Then once you have all those figures for the three parts, you likely in this case now get the net increase in cash, net increase or decrease in cash and cash equivalents. So the net, you get the net increase or decrease in the cash and cash equivalents and cash equivalents. And how do you get this? You take A plus B plus C. So there's a figure you'll be able to get. You take what you got here, what you got here, there. You see why I was having to put a B here? It's because of this final place here. So you get, after you close here, you'll have the net increase or decrease in cash and cash equivalents. How do you get it? You add the three figures, A, B, and C. You'll get a figure here. Then once you have that figure, you add on, in this case, you add on the opening cash and cash equivalents. You add on the opening cash and cash equivalents. So with that, you'll be able to have the closing. You'll have the closing cash and cash equivalents. You'll have the closing figure in terms of cash and cash equivalents. So if you don't get this closing figure, it means your cash flow statement is not balanced. There's a problem. So you must actually always be able to get what was the closing figure in terms of the cash and cash equivalents in the statement of financial position for the end of the year. So if you don't get that figure, then it means that's how you identify whether your cash flow statement is having to balance or not. So if you add on this figure the opening cash and cash equivalent and it's not having to come to the figure at the end, then things have gone marambas for you in these other places. Maybe you have actually messed up with the other figures. That's why it is not having to balance. Therefore, you have to be able to do a recheck your cash flow statement. So that's why in this case, you actually end up having to present. That's why in this case, you end up having to present that. So you cannot be able to see up there redemption of shares. That is redemption of shares. So we are going to have a break. We are going to have a break. A small break. Then when we come back, I want us in this case, we look at a question. When we come back, I want us to look at a question. There's a question which I want us to look at. So we're going to look at December 2024. You open that question, December 2024, question number 3. We have a break. Then when we come back, I want to look at December 2024, question number 3. So be opening that particular question. The opening that particular question is what I want us to look at as an illustration. We can proceed. So we can proceed. So confirm there whether we can continue. Confirm there whether we can proceed. Yeah, so hope you've opened that question because it's the one I want us to look at. Hope you opened that question is the one I want us to look at as our illustration. So the question is from December 2024, question number 3. December 2024, question number 3. Yeah, so we start. So I look at part A, although in this case is not under this part. We've already covered that area. Government grants is under topic number 1. It says, outline the accounting treatment of government grants related to income in accordance with the International Accounting Standard number 20, accounting for government grants. So the accounting treatment of government grants related to income. Related to, in this case, what? Income. Government grants, when in this case you are given funding by the government, you're given some grant by the government. Maybe it could be a public sector entity, maybe like a school, or maybe in this case, you could be, maybe in this case, be what? Like maybe like in this case, what? Cooperative society. You can, in this case, get some government support. So how in this case do you account for it in the books of accounts if it happens to be an income? So in this case, right, part A, right, IAS number 20 states that government grants, IAS number 20 states that government grants, IAS number 20 states that government grants should not be recognized until, IAS number 20 states that government grants should not be recognized until the conditions for the receipts, receipts like this, the conditions for the receipts have been complied with. The conditions for the receipts have been complied with, and there is a reasonable assurance, that the grant will be received. And there is a reasonable assurance that the grant will be received. And there is a reasonable assurance that the grant will be received. There's a reasonable assurance that the grant will be received. Then another paragraph, you write. Another paragraph, you write. So we are saying IAS number 20 states that government grants should not be recognized until the conditions for the receipts have been complied with. The conditions for the receipts have been complied with, and there is a reasonable assurance that the grant will be received. And there is a reasonable assurance that the grant will be received. So in this case, you don't just recognize grants in your books of accounts. Before you get this grant, they might call upon you to fulfill certain conditions. So you only, in this case, recognize you will receive that grant if you have actually been able to fulfill those conditions. Maybe it could be you are supposed to provide an account as to how you spend the previous grant before they give you the money. So you will only in this case be able to recognize it if you are sure you can be able to meet those kind of conditions. Then the next paragraph you write, grants should be matched with the expenditure towards which. Grants should be matched with the expenditure towards which they are intended to contribute. Grants should be matched with the expenditure towards which they are intended to contribute. They are intended to contribute to grants should be matched with the expenditure towards which they are intended to contribute to in the statement of profit or loss. 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 Then the next paragraph you write, income grants given given to subsidize expenditure should be matched to the related costs. Income grants given to subsidize expenditure should be matched to the related costs. So in this case, you go to the income statement and identify this grant you're having to receive was for what? Maybe in this case, it was supposed to subsidize, in this case, what, the electricity. So you must actually be able to match on that expenditure, and you subsidize, it has actually been paid by that grant. So income grants given to subsidize expenditure should be matched to the related costs. The next paragraph, you write, income grants given to help achieve a non-financial goal. Income grants given to help achieve a non-financial goal. Income grants given to help achieve a non-financial goal, such as a non-financial goal, such as, or e.g., I'll give an example, e.g., such as, or maybe e.g., job creation, training, etc., e.g., job creation, training, etc., should be matched to the costs incurred, should be matched to the costs incurred, should be matched to the costs incurred to meet that goal, should be matched to the cost incurred to meet that goal. Should be matched to meet that cost incurred to meet that goal. Another paragraph, you continue writing. Grants related to income can either be presented. Grants related to income can either be presented as a credit. Grants related to income can either be presented as a credit, can either be presented as a credit in the statement of profit or loss, as a credit in the statement of profit or loss, as a credit in the statement of profit or loss, or they can be deducted, from the related expense, or they can be deducted from the related expense, or they can be deducted from the related expense, or they can be deducted from the related expense. So that's what will happen if, for example, you are given a grant in form of an income. So you can actually defray of that expense in the income statement, or you just go and actually recognize it as an income in your profit or loss, or loss. So that's part of what in this case happens if you're accounting for government grants. So that's an area where I think we've already covered. I don't know whether we've already covered. It should be under, is it topic 1 or something? Yeah, so accounting for government grants. So we can look at now part B, 𝗿𝗏. We can look at 𝗿𝗏. So you are told the draft financial statements set out below relate to 𝗿𝗏 Limited, a public limited company. So you are given in this case a statement of financial position for 2 years, and this is what will happen if you are in this case being called upon to prepare a cash flow statement. You'll be given financial statements in terms of the statement of financial position for 2 years. So you're given for the year 2024 and 2023. It means what you're having to see in 2023, those are the opening balances for the year 2024. And what you're having to see in 2024, those are the closing balances for the year 2024. So the opening balances for the year 2024 are under 2023. And the closing balances for 2024 are in the column of 2024. You are given in this case the non-current assets, which are property, intangible assets, investments at fair value. Then you are told the current assets are inventory, accounts receivable. This is what you are having to talk about what as the working capital items. So the inventory and the accounts receivable. So we'll adjust them in this case under what? The changes in the working capital items. The cash and cash equivalents. So what you're having to see there as 2485 is the very final figure in the cash flow statement. It should come to 2485. Otherwise, if you don't get that, it means in this case, your cash flow statement has not balanced. So what you have there as 2485 should be the very final figure you get in your cash flow statement. Otherwise, if you don't get that figure, you see that last figure we've been able to indicate the last figure in the cash flow statement in our format. If you don't get that figure 2485, it means things are not okay with your cash flow statement. You're given some capital items or equity items. So these are the ones you're having to say you majorly consider them under the financing activities. So you have ordinary share capital, share premium, revaluation reserves, retained profits, so like that. Then in this case, you are given the non-current liabilities. These are also in this case financing activities. So majorly in this case, we'll have long-term borrowings. We have the deferred tax, which in this case you have to consider under the tax paid. We have the current accounts payables, which is in this case a working capital item. Current tax is a tax item. So you'll consider it when you're having to determine the tax that was actually paid. You're given an extract of the P&L account for the year ended 2024, 31st of October 2024. So from this, we'll be able to get the profit before tax, which is our very first figure in the cash flow statement. You'll pick it from here. So you'll get that figure 3335 there. That's where you'll be able to get the figure. So the other figure you pick from here is the finance cost, is normally here. The finance cost, you see that finance cost, what you've been indicating in the cash flow statement, finance cost, we'll be picking that figure there. Then, so we have in this case additional information that you've actually been given there. You are told during the year ended 31st of October, the directors of the company accepted a property revaluation report at a gain of 4.5 million. The company does not make reserve transfer for excess depreciation upon revaluation. You see that 4.5 is what you are seeing in the, you see other comprehensive incomes in that P&L extract. That figure you are seeing 4.5, there is what is actually there in note number 1. Then depreciation on non-current tangible assets. Non-current tangible assets, charge to profit or loss for the year amounted to 2780. So we have in this case intangible assets in the statement of financial position. So this depreciation will be able to help us to know whether in this case there was an acquisition or not. Or in this case, what these intangible assets we'll be able to see. Then during the year, new patent rights were acquired at a cost of 4 million. So that's like in this case, what an intangible asset. That was an acquisition. That was an outflow. It was an outflow. So in this case, when you're looking at investing activities, there's somewhere been able to say acquisition of what of assets. So if you acquire an asset, you spend the money. So already that figure will be able to appear under what investing activities, 4 million. But now it will also be able to help us to know in these intangible assets you're having to see. Because that a patent, is it a patent? A patent is an intangible asset. Is an intangible asset. We'll come up with that account and actually be able to know when in this case there were any assets which in this case were actually acquired there. But in this case were actually acquired there. Then the investments held by 𝗿𝗲𝘁 Limited are measured at fair value through profit or loss. Neither purchase nor sale of the investments occurred during the year. We have in this case some investments at fair value. So you are advised they neither sold or in this case bought. And therefore in this case there was what? There was like in this case what? A fair value gain. There was in this case a fair value gain on these investments. So you can see, if you look at in this case, look at that investments at fair value in the statement of financial position. I don't know whether you are able to see it. I don't know whether you are able to see it. So there is a figure of 5,500. There is a figure of 5,500 at the start. Then at the end, there is a figure of 5,825. So these are the end. So there's a difference here of 325. So this 325 is what you're having to see. You see in the P&L extract, there's a fair value gain on investments. hope you can be able to see it. So that's what you're having to see there. There's a fair value gain on investments. So this one we'll be able to consider it under the non-cash items because it doesn't represent real inflow of cash. It doesn't represent a real inflow of cash into the business. But in this case, it was recognized under the P&L account. So there was no money that was received here. But now it's like in this case, they have recognized as it having to add to the profit before tax. It is being added on the profit before tax to come up with the profit before tax. But in this case, it doesn't mean that money came into the business. There's none of these 325 we received it, like real cash. So in this case, it will be amongst what the non-cash items. These 325, these 325 there. So then in this case, we can be able to try and actually see how you could have actually been able to present this cash flow statement. So you can be able to do a few workings, and majorly the workings are normally touching on the PPE. So you have to do something about PPE, or generally just in this case, look at what you've actually been advised in the additional information to see what is having to happen there. What in this case is actually having to happen there. What is having to happen there? What is having to happen there? So we can do the first working one. We can come up with a PPE account and come up with a PPE account to see whether there was actually any acquisition. To see whether there was actually any acquisition. So in this case, we can present our figures in shillings of thousands. And that is according to note number 1. So in this case, you look at the PPE. The opening figure, you can be able to see it in the extracts of the statements of financial. The opening balance brought down is actually 54,116. While the closing figure, the balance carried down, is actually in this case 72,475. 72,475. 72,475. But there's something you're having to be told in note number 1. During the year ended 31st of October 2024, the directors of the company accepted a property revaluation report at a gain of 4.5 million. So that 4.5 million, what will we do with it here? What will we do with it here? So during the year ended 31st of October, the directors of the company accepted a property revaluation report at a gain of 4.5 million. So the company does not make an inter-reserve transfer for excess declared upon what revaluation. So what will we be able to? We'll debit. We'll likely end up having to debit. So there was a revaluation here. So we write revaluation because it was increasing the value of the asset. We debit here. So 4.5 million or 4.5 million, 4.5 million. Then still in note number 2, you are advised depreciation on non-current tangible. Non-current tangible are still basically under PPE. These are ones that you can be able to touch and feel. Non-current tangible assets. Charge to profit or loss for the year amounted to 27,810. So this means it was having to reduce the value of these assets. So we can be able to put here depreciation because assets then increase with debit. When they lose value, you actually end up having to credit. So it means they lost a value of, in this case, 27,810. 27,810. So with these, we can actually be able to know. There's not in this case any other indication as to in this case whether this PPE was actually affected. These are only in this case the effects we have in what? The property, plant, and of course what equipment. Take note. The main reason as to why in this case you come up with this account, there's usually just major one reason. You want to know whether in this case there was any acquisition of property, plant, and equipment. This concept, it will rarely miss in a cash flow statement. Question. It will rarely miss. This concept of coming up with a PPE account and knowing what were the acquisitions during the year, it will never miss. It has rarely missed. It has rarely missed. It is always there. So therefore, the essence of coming up with this account is to know that in this case there were any acquisitions or disposals during the year. And therefore, in this case, if you realize that in this case, the balancing figure, you'll have to, in this case, balance this account. You'll likely end up having to balance this account. If it happens that in this case, the assets are having to increase here, then it means there were what? Acquisitions. It means in this case, the balancing figure happens to be this side. It means there was somewhat disposal of, in this case, of this equipment. And therefore, it means, obviously, our balancing figure is this side because you can be able to see this side is more. So what are you getting when you add the credit side there? Because the one that is actually more. And therefore, the difference should be able to give us what the acquisitions during the year. Should be able to give us the acquisitions during the year, which are in form of what? Cash. What you get as the total here is a figure you'll be able to get there. You're getting 165, 75, I can say 75, 255, and the acquisition 16,595. So 16,595. So I can see the total we're having to get 75, 255, 75, 255. 75. And therefore, the essence here, basically, it is to get this figure, which in this case will appear under what? The investing activities. And this one, this one now in this case, it will likely end up having to appear under what? The non-cash items. So there are two figures here. This one you've been given in the additional information, you already have it. So it will appear under the non-cash items. This one will likely end up having to appear under the investing activities. So that, like that, you would have already been able to get that. You would have actually already been able to get that. Then, you've actually been told during the year there were new patterns that in this case were acquired. So we can go to, in this case, patterns are intangible assets. Patterns, you might have learned about them. So you people have been able to learn a lot of law and governance. You know what are patterns. So patterns are in this case acquired when you do an invention. You protect them under what you call what? The patent, as a patent. And therefore we can have the intangible assets. Intangible assets. So suppose for the intangible assets, you've already been told what? The acquisitions. And these intangible assets, the opening balance that you have there, you've already been told the acquisition. So what majorly you'll likely be looking at, whether there was actually any loss of value on what the intangible assets during the year. So you've actually been given an opening balance of these intangible assets. So you have a balance wrote down, or in this case, 5,500. And then you have in this case a balance carried down, or in this case, or it is 12 to 40. This one is supposed to be 12 to 40, 12 to 40, and this one is actually 15,700. You've already been told there were acquisitions. You've already been told there were acquisitions, which in this case they spend cash on, of an amount of 4 million. Or an amount of, in this case, 4 million. There were acquisitions. So you, in this case, supposed to get, like in this case, the balancing figure. The balancing figure. And of course, if it comes this side, it likely basically means there was loss of value on these what? Assets. And therefore, in this case, you can be able to see we are getting 16, is actually 16,240. And this one is 16,240. So what is the balancing figure there? There's a balancing figure you're getting. There's a balancing figure you're getting exactly 540. So that 540 is the loss of value. The 540 becomes what? The amortization. For intangible assets, we don't depreciate them. It is the amortization. And therefore, this one will appear under what? Investing activities. And this one will appear under the non-cash items. It will appear under the non-cash items. That is in this case what? The amortization. That is the loss of value, or in this case what? The intangible assets. It's like now we are looking for this one there. You see, we were looking in this PP, we are looking for this one. There it is like we are having to look for this one there. So we'll be able to go to, in this case, what? The non-cash items. It will go to the non-cash items. It will likely end up having to go to the non-cash items. Then, always in a cash flow statement question, if you look at, in this case, the format you've actually been able to come up with there. The format you've actually been able to come up with there. And of course, you can be able to put like a star, an asterisk, or in this case, you mark with a red pen. You mark with a red pen. The tax paid, always you'll have to compute it. The tax paid, you likely always, like in this case, end up having to compute it. Especially in this case, you see in the statements of financial position extract, you've actually been given the deferred tax and the current tax. You'll always actually be able to do that computation and be able to know what was the tax paid during the year. Because in this case, what you'll be given in this case in the P&L account. You see that figure you're having to be given of income tax of, in this case, 1330. It's like, in this case, that is what, in this case, they provided for the entire year. But now, in this case, you have to look at exactly how much they actually end up having to pay. How much they actually end up having, in this case, to do what to pay. So therefore, in this case, you can be able to come up with the income tax expense account. The essence of having to come up with it, mark in that cash flow statement format of yours with a red pen. You have a red pen. You need to be having a red pen. The tax paid. You see where you're having to put the tax paid. That figure, in most of the instances, this case, you likely end up having to do what? Compute it. And how do you compute it? You come up with an income tax expense account. Income tax expense account. You come up with an income tax expense account. So the income tax expense account will have two compositions. We'll have two compositions. This is like, in this case, what? A liability. It will have two compositions. We'll have the balance is a liability. It is a liability. It is a liability. It is a liability. And therefore, the opening figure is actually on the credit side. So, Millicent, are you seeing that? Is on the credit side like that. Is on the credit side like that. And therefore, in this case, you have two of them. You have, in this case, what? Two of them. So you have, in this case, CT, not sweetie, but CT. Current tax, not sweetie, but CT. Then DT, not DT, but deferred tax. Not DT, but deferred tax. CT, not sweetie, but CT like that. So for CT, you can see the opening balance for CT is 1485. 1485. And the opening balance for DT, not DT, but in this case, what? Deferred tax, it is 1955. 1955. Is there anyone who was born in 1955 here? So, but now in this case, you are being told it's 1955. So we have the balance carried down at the end. Balance carried down at the end. We have CT, and we have, in this case, what? DT. So for CT at the end, you have a figure of 1880. 1880 is on the enzi za mababu zetu. Enzi za mababu zetu. 1880, then you have, in this case, DT. So for DT, you have, in this case, 2370. 2370, huko tujafika bado. Huko hatujafika bado. Huko tutafika 2370. 2370. So that's what you're having there. Then when you go, in this case, to the income statement extract, in the P&L account, there was an income tax expense for the entire year of an amount of, in this case, 1330. 1330, like that. 1330. 1330, like that. So like that, 1330. And therefore, we can be able to balance these accounts. When you balance this account, you'll likely be able to know what was the tax paid. So you'll have the cash or the tax paid during the year. So the cash they incurred to pay. So what is the total we are getting here? You need to be able to give me the totals here. What is the total here? This is the side that is more. 1485 plus 1955 plus 1330. What are you having to get? I can see 4770. Is that correct? Millicent, today you're not giving us figures here. 4770. 4770. So 4770. 4770. I can see 𝐸𝐿 today is trying. 𝐸𝐿 today is trying. 4770. What is the balancing figure here? What is the balancing figure here? It is 520. 520. So you see, have you marked with a red pen in that extract, in that format? So that figure, we normally calculate it like this. You prepare this account and it will help you to get that figure for the tax paid. So you have to master, like in this case, you get the opening balances, you put them here, the CT and the DT. If you've only been given current tax, don't start imagining that there must be deferred tax and you start getting confused in the example. If they're only giving you CT, just put CT as you continue. If they are giving you only DT, put DT as you do what? As you continue. Don't start imagining that it must be there, not a must. In this case, you can only be given what? The current tax. But ideally, in most of the instances, you'll be given both. You'll be given both. Another easy way to not waste a lot of time, don't separate them the way I've separated. You just say balance brought out, then you add the two, you put one figure here. Balance carried out, add the two, you put one figure here. You don't have the luxury of time in the exam room. In this case, break down each and everything. If you can be able to simplify the workings as much as possible, please do Please don't say that in this case, Malim said in the class, you must be able to separate them in the working. The workings account for 0 marks. What you're just having to do here is just need to be able to make it to get a far much better understanding. But when you're approaching the exam, we advise you be smart enough. You be smart enough. You simplify the workings in the best way you can. In the best way you can. In fact, in this case, you've already been able to master the process. You just say this plus this plus this. Then you minus this, you get this. But now to get a better understanding, we use what? An account like this. So you start having to say, this Malima, I even don't understand what he's having to say. Where are we getting the 520? This is how we're having to get it. So under that place of tax paid, we'll place what? This particular figure here. So we'll place that figure there. Then in this case, also, there's another one. You can be able to mark it also with a red pen. Red pen, you know, it shows what? 𝐷𝐞𝐭𝐚𝐤𝐞. It shows 𝐷𝐞𝐭𝐚𝐤𝐞. With a red pen in that format of yours, you can also be able to mark what? Dividend paid. You can be able to mark dividend paid with a red pen. Red pen shows what? 𝐷𝐞𝐭𝐚𝐤𝐞. With that one, you prepare this account. Retained earnings. Retained earnings. You prepare this account, retained earnings account. Retained earnings, you'll actually be able to see it under the equity items. You'll be able to see it under the equity items. You'll actually end up having to see it under what? The equity items. You'll be able to see it under the equity items. So in this case, you put here shillings in thousands. So like that, you put here shillings in thousands. So this one, it has an opening balance on the credit side. So in this case, you put here the liabilities and of course equity items, their opening balances are normally on the credit side. So the income tax expense, those are liabilities, they are here. So we'll say here balance. Wrote down. You can see it under the equity items. Millicent, are you having to see it? Millicent, are you having to see it? Is giving us a figure of what? 14,755. 14,755. Well, in this case, at the end, we have a balance carried down in the retained earnings of a figure of 17,505. During the year, they made some profits. During the year, they ended up having to make what? Some profits. During the year, they made what? Some profits. So in this case, from the P&L account, profit for the year. So for the year, they had actually made some profits. So for the year, they had actually made some profits. So they retained earnings of, in this case, an amount of 33.35. This one, you can get it from the income statement extract. This is the profit they made for the year. They opened with the retained earnings of 14,755. But of course, in the year, they were not having to relax. They were working. They were working and they made profits. So they added on some profits. So you're expecting the total at the end of the day should be this plus this, but you're having to be given this figure. It means if this figure is less, they must have paid somewhat dividend. So therefore, in this case, what is the total here? What is the total here? What you'll be able to get here is the dividend paid. Is the dividend paid. Of course, it will be in form of what? Cash money. Cash money. It will be in form of what? Cash money. What are you getting here? Is a figure you are getting. Is a figure you are getting. You are getting what? 18,090. 18,090. 18,090. So you place here 18,090 minus this. You'll be able to see the dividend that was actually paid during the year. 585. I can be able to see in this case, Edna has already been able to get it. 585. You people are just smart. You people are just smart and very fast. 585 is in this case the figure you'll actually be able to get there. That in this case means what? That was the dividend that they ended up having to pay during the year. So under dividend payable or dividend paid during the year, they are under financing activities. We'll be able to place what? This figure. We'll place this figure. And of course, now in this case, under the tax paid, we'll be able to place this figure. Those are like in this case the key ones that you'll actually end up having to do it to come up with. So you have to ensure you'll be able to come up with this one. So the other items in this case, we'll likely be able to see them having to change according to, in this case, what will be the opening balance and the closing what? Balance. And therefore, with these ones, let's try and actually see, will we be able to have like the cash flow statement? Will we be able to, in this case, have like, in this case, what the cash flow statement, or what in this case is having to happen, what is having to happen there? So let's, in this case, try. Let's try. Because we are only remaining with 15 minutes. But let's start. Let me give you the direction. Let's start. let's start the process. Let's start the process and see how far we can be able to go. So 𝗿𝐿 Limited. So 𝗿𝐿 Limited cash flow statement for the year ended 31st of, is not October, 31st of October 2024. So of course we can be able to present our figures in shillings of thousands. We're dealing with shillings of thousands, not cows, not goats, but just serious money. But just what? Serious money. So cash flows from operating activities. From operating activities, cash flows from operating activities. So we're just dealing with what? Serious money. Because you underline like that. Make sure that in this case, your work is so much organized, even far much better than what? Mine. Even far much better than in this case, what? Mine. So the share premium will just be able to handle it directly. So don't do the account, you'll be wasting time. Don't do that account, we'll just handle it directly inside the cash flow statement. You'll see the difference from the start to the end. So don't actually, in this case, do the account there. So you'll just be wasting your time. To save on time, let's move. So in this case, profit before tax. Profit before tax. The profit before tax, you can be able to see the figure. You've been given, in this case, in the income statement extract. The profit before tax, it is 4665. So 4665. Then in this case, you say with this one, you adjust with what? The non-cash item. Adjust the non-cash items. So for the non-cash items, we have in this case depreciation, which you've in this case been able to, we've actually been given depreciation 2780. We have amortization, which will come up with in the intangible asset account. Amortization is exactly an amount of amortization is how much? 540, exactly 540. It is 540. It is 540. It is 540. Then we have fair value gain. Fair value gain on investments. You see, it has been included. It has been included as part of this. You see, if you look at the income statement extract, it is inside this one, but it doesn't represent real inflow of cash. These were just, for example, shares which value, the one went up, but the company didn't receive that money unless they sell. They didn't receive that money. So in this case, we'll actually end up having to deduct that amount. So 325. Then we consider the finance cost. Remember, we also said we put here the finance cost. The finance cost, because it was deducted, so you'll actually in this case end up having to add it back. You'll add it back here. So there's a figure you should be able to get. So those are the only items affecting there. What you get when you add, so 2780 plus 540 plus 325 plus 1200. You're getting 8860. So 8860. You'll be able to get 8860. So like that. 8860. Then in this case, you consider what? The working capital item changes. So the working capital item changes. So we can be able to put a line there. So you consider the working capital item changes. So the working capital item changes that you have here, it is the inventory, accounts receivable. So you have in this case inventory. We have inventory. We have accounts receivable. And we have, so the cash and cash equivalents, don't consider them. That's what is helping us to balance. You go to the current liabilities, we have the accounts payable. Majorly, they'll be these three. Majorly, they'll be these three in the exam. So they like these three, the accounts payable. So you'll have to consider whether in this case, the inventory is increasing or having to decrease, is increasing or decreasing. Like in this case, for the receivables, and in this case, for the inventories, they're having in this case to do what? To increase. So for the receivables, they're increasing. They're increasing, and of course, for the inventory, they're also increasing. So you have to consider that increase. Right? So in this case, from 7040 to 7485. So in this case, we have 7485 minus 7040 from the start of the year. Then for this one, it is 5830. Not 5830, but 6030 minus 5830. What are you getting? This one seems to be 200. Is it 200? Accounts receivable. What about inventory? Inventory, we can start with the inventory. It is increasing by how much? Inventory is increasing by 445. So in this case, 445 we deduct. This one will be increasing deduct. This one is 200. When they're increasing, you deduct. Then accounts payable. Accounts payable, we look at accounts payable. They're also increasing. So there's an increase. They're also increasing. So the accounts payable in this case are having to increase. From in this case, what? For 35 or 5, so you have 46. 46, 45. 46, 45. Minus 35 or 5. Minus 35 or 5. So they're increasing from 46, from 35 or 5 to 46, 45. So they're increasing from 46, from 35 or 5. In this case, 46, 45. 46, 45. So in this case, we said if in this case, these ones are having to increase, you likely end up having to add. So the difference is how much? The difference is 1140. Is it 1140? 1140. So in this case, we'll add here 1140 because they're having to increase. So we'll have in this case now the total. You can be able to get what the net cash flows from operating activities. From operating activities. So there's a figure you'll be able to get here. So what do you get? You need to add from here 88 minus that plus 1140. You're getting 93.55. I can see you're saying 93.55. 93.55 seems to be the correct figure. So 93.55. 93.55. So we haven't actually been able to consider taxes. So we want to put this one first. So 93.55 to 93.55. Moving so fast, moving so fast. So less tax, tax paid. This one you've already been able to compute. Then less the finance costs. Less the finance costs. The finance cost is here. So you come and actually just deduct the same figure. 1,200. Then the tax paid, we've also been able to do it in the income tax expense. It was coming to a figure of 520. It was coming to a figure of 520. So we deduct 520. So with these ones now, at least we can be able to come up with the net cash flows from operating activities. The net cash flows from operating activities. Then now the final figure for the part A. The final figure for part A. What is the final figure for part A? So 93.55 minus 520 minus 1,200. You're getting 76.35. So 76.35. So we'll have 76.35. So like that. So that is the first part. So this is how you present it. The first part of cash flows from operating activities. Cash flows from, in this case, what? Operating activities. So you can go to the second part, which in this case is now cash flows from investing activities. Hope you are through with here. Cash flows from investing activities. So you have now, in this case, cash flows from investing activities. From investing activities. So we have in this case two acquisitions, acquisition of PPE, and we have acquisition of, there was that acquisition of, in this case, the patents, acquisition of patents. So acquisition of patents, it was an amount of 4 million. So because it was an acquisition, you deduct There was also an acquisition of PPE, which you've been able to get in the property, plant, and equipment. It was 16,595. So 16,595. So there were only these two acquisitions. There was no any other. If there was a disposal and you got some proceeds, we would have added, but we haven't actually been told. So these are the only acquisitions that were there. But if we are told an asset was disposed of, then we would have actually been able to put it here. But it is not there. So let's not in this case start imagining what is not here. So we only have these two items. So in this case, it brings what? 20,595. And this is the second part of the cash flow statement. So it's a negative. You put in brackets. It is a negative. So these are net cash flows. Net cash flows from investing activities. Net cash flows from investing activities. So like that, you put like that, and you would have gotten the second part. You would have gotten the second part. So you can go to the final part, which in this case is cash flows from financing activities. Cash flows from financing activities. Here now you look at how the equity items are having to change. You look at how the equity items are having to change. So if you look at the ordinary share capital, they opened with 40, but now they are closing with 50. So in this case, you have the ordinary share capital. The ordinary share capital. The ordinary share capital. There's in this case some sale of shares there. They must have in this case sold some shares there. So in this case, there was an issue of shares. Issue of shares. Issue of shares. So in this case, on ordinary share capital, the issue of shares is actually in this case giving us what? 10. So how do you get a 10? You take 50 minus 40, because they open with 40, you get 10. You take 50 minus, in this case, what? 40. They open with 40 in the ordinary share capital, but they are closing with 50. So that basically means they're able to finance their business with the ordinary share capital of extra 10 million worth of amount in shares having to be received. So still on the share premium, there's an increase, which is just still from the same issue of shares. On the share premium, there's an increase. So the share premium, on the share premium, just still under the same, there's an increase. So we have share premium. Still is from issue of shares. So in this case, on the share premium, you can be able to see they opened with 10, but they are having to close with what? So 12,500 minus 10. So they got extra amount in share premium of 2.5 million. Of 2.5 million, 2.5 million, 2.5 million. Then we have dividend paid, which you've already been able to dividends paid. The one you come up with in the retained earnings account. There's a dividend paid, which in this case, been able to come up with in the retained retained earnings account of an amount of 585. So this one money was going out. So 585 you deduct. Then the other financing activities, you can be able to get them under the non-current liabilities. So under the non-current liabilities, you have long-term borrowings. Long-term borrowings. So for long-term borrowings, they opened with, in this case, 10,300, but they are closing with 11,600. So they must have, in this case, borrowed. So 11,600 minus 10. This basically is still financing the business. And therefore, this one comes to what? 1,300. So this money came in. So that's when you likely end up having to add like that. So 1,300 like that, 1,300 like that. You'll end up having to add 1,300 like that. So with that, you'll likely be able to get the net cash flows from financing activities. So you need to add, what are you having to get? the net cash flows from financing activities. There's a figure you'll be able to get, which is part C now. There's a figure you're getting when you add these ones, the four of them. What are you getting? You're getting 12, 13. Don't consider evaluation Nancy. You see that evaluation? Nancy? Look at it. There's a difference of how much? Nancy, give me the difference of that evaluation. 13. It is 13. I can say 13, 215. So I can say 13, 215. Nancy, what is the difference there? So you've already been able to consider that. So don't ignore it. You've already been able to consider that in the PPE account, and also it is there. It is there. We've already been able to consider it in the PPE account. So don't consider it. Ignore it. Ignore it. You've considered it in the PPE account there. So you're getting 13, 215. So therefore, in this case, we can get what? The net increase or decrease in the cash and cash equivalent. So net increase or decrease in cash and cash equivalents. What are you having to get as the net increase or decrease in cash and cash equivalents? You added the 3. So that means A plus B plus C. So that's what you're having to mean there. Akoyo. What are you getting? Akoyo. The net increase or decrease in cash and cash equivalents, you're getting how much? I can see a figure of 255. So 255. What do we say? We add on the opening. So add on opening. Add opening cash and cash equivalents. So what is the figure for the opening? Add the opening cash and cash equivalents. Millicent, add. The opening cash and cash equivalents is actually 2230. 2230. So with these, we should be able to get the closing cash and cash equivalents. So what is the closing cash and cash equivalents when you add? What is the closing cash and cash equivalents when you add? You get 2485. 2485. Right? So you're saying 20.